Everybody, welcome back to the channel, Marathon Capitalist. Please like and subscribe to the channel. That's much appreciated. Today, I'm gonna do a little something different. As I always say, try to keep it different. Try to keep it giving y'all something new every time I get on here. See what people kind of like. But today, I'm going to be talking about something that I had no idea about when I got into the workforce, and that was retirement plans. And we all need to be set up for a retirement plan, through funding. And here are a few ways that you can do it. I'm going to talk about 4 different strategies that are out there, 3 of which are currently being used by most people nowadays. One of them is not. But the first one, the most common one, is going to be the 401k retirement plan. And basically what this plan is and I'm getting all this information from Investopedia, and I'm not going to go too much in detail. I just want to give you basic knowledge of this, so if you haven't heard of these, you can understand the routes that you can take in order to start your retirement plan. So the 401k plan, retirement savings plan, offered by American employees that has tax advantages. um, those who agree to the 401k plan have a percentage of each paycheck directly from their check into an investment account. The employer may match part or all of the contribution. So basically, if you put in 5%, your employer may match up to 5%. Some employers match up to 7%. But if you only put in 3%, they'll probably only match 3%. They're not going to match 7% the entire time. But make sure you check with your employer on that. And then with a 401k, there are some taxable benefits that you can go into. Is basically all the income that you spend to your 401k, since it comes out of your gross income. It can be used as a tax deduction for that previous year. So any contributions that you make the following year, you can use as a tax deduction for that year. And then no taxes are due on the money that you contribute or the earnings until the employee withdraws the money. So you won't be taxed until after. Keep calm. I love coffee. Sorry. Okay. So the next one, we just got done talking about for traditional 401k. Now I want to get into Roth IRAs and traditional IRAs. And basically what an IRA is, a individual retirement account that has tax advantages. Just another vehicle that you can put your money in to help you build some type of wealth. And some of these can be done through your employer. And then there's some where you can get them on like Webull, Fidelity, TD Ameritrade, or places like that. So basically a traditional IRA contributions are tax deductible on both state and federal tax returns for the year you make the contribution. As a result, withdrawals, which are officially known as distributions, are taxed at your income tax rate when you make them, presumably in retirement. Contributions to traditional IRAs generally lower your taxable income in the contribution year. This lowers your adjusted gross income, possibly helping you qualify for other tax incentives. So that's basically what a traditional IRA is. It's just another vehicle, like I said, you can put your money in to help you grow. Now, a Roth IRA, and then I'll get into some of the differences afterwards. So, a Roth IRA, you don't get a tax deduction when you make when you make contribution to a Roth IRA. This means it doesn't lower your adjusted gross income, but your withdrawals from your Roth IRA during retirement are tax free. So you pay your taxes up front in a Roth IRA, and then you pay no taxes once that money is being withdrawn. Once you decide to retire, you kind of paid the bill up front. So that's kind of the difference between the Roth IRA and the traditional IRA. Just make sure you do your own research on which one is more important. I like paying taxes now because your dollar is worth the most now. That they say your dollars won't be worth as much in the future. All right, and then to highlight some of the key differences that it says on Investopedia, both traditional Roth IRA and provides generous tax breaks. It says it's a matter of timing when you can claim them. Anyone with earned income can contribute to a traditional IRA. Whether the contribution is fully tax deductible depends on your income, whether you are covered by an employer-sponsored retirement plans. Now, there are some restrictions on Roth IRAs. You can only put up to like 6,000 in them per year. That's both of them. Doesn't matter traditional or Roth IRA. You can only add a specific amount. And then you also have what they call distributions that you have to start taking out at a specific age. Required minimum distributions because they don't want people tax harvesting. But you can do more research on that. Now that is the difference between the IRA, the two IRAs. Now, the last one that I'm gonna get into is the pension plan. Most people don't have pension plans nowadays. I don't believe, but most companies don't give out the pension plan benefits anymore. They are onto 401ks or individual retirement accounts simply because what a pension plan is, the employee or the employer plans to commit the benefits to a regular employee to make them regular contributions for the rest of their life after they retire. So once somebody retires, they are expected to get a check from this specific company for the rest of their life. Those traditional plans are out the door. It was costing the government too much, I'm sure, or costing these companies too much. Wasn't enough money out there to pay everybody. I'm not going to go too much in further detail about the pension plan. I don't believe most employers offer them anymore. I could be wrong, but do your own research. I know I've heard of the 401k. I heard of traditional IRA and Roth IRA at all the employers that I worked at. I haven't heard of any pension plans. So make sure you do your own research. If y'all like this, please like and subscribe. Please leave me comments below. If y'all have any questions, please leave comments below. And we'll get back to you. And just like that, Marathon Capitalists, we out.